All right, let's get right into it. The U.S. real estate market, as of mid-2025, it's a real puzzle. We're seeing record-high home prices, but also a major slowdown. And depending on where you look, a house, an office, a warehouse, you get a totally different story. So let's break down what's really going on behind the headlines.
So here's the big question, right? The one that seems like a contradiction. We're seeing home prices hit all-time highs. But at the same time, all that crazy energy we saw a couple of years back, it's pretty much gone. How can both of those things be true at once?
So what does this new record look like in actual dollars? Well, get this. The new national median home price is $435,300. That is, to be clear, the highest it has ever been, period.
But, and this is a huge but, here's the twist. While the price tag is at a record, the growth has just about flatlined. The year-over-year gain is only about 1%. I mean, think about the double-digit jumps we got used to. It's like a rocket that shot for the moon and has now just run out of fuel. It's floating high, but it's not going any higher, at least not very fast.
And that brings us to the main story for residential housing. The best word for it is a plateau. We're rebalancing. All that frenzy, all that craziness from the pandemic boom, that's over. We're settling into something that feels, well, a little more normal. A very, very expensive normal, but normal nonetheless.
And you can really feel the difference if you just compare today to a few years back. You remember 2021, right? It was pure frenzy. Barely any homes for sale, insane bidding wars, houses selling in what felt like minutes. Okay, now fast forward to today, 2025. The script has totally flipped. Inventory is actually going up. Sellers are having to cut prices, and homes, they're sitting on the market longer. If you're a buyer, it means you can finally take a deep breath.
You know, this national plateau is hiding some really dramatic differences, though. It's a great reminder that all real estate is local. I mean, look at this. The Northeast is still chugging along with price growth over 4%. But the West, which used to be red hot, has cooled way down to just 1%. It's not one market out there. It's a bunch of different little markets, all with their own stories.
So what's causing these huge splits between regions? Honestly, it boils down to one simple word: supply. In the Sun Belt, they've been building like crazy. All that new construction gives buyers more choices and, cools down the price pressure. But then you look at the Northeast. They're still chronically undersupplied. When there's less to buy, the competition stays fierce, and that's what keeps pushing prices up.
All right, let's shift gears. We've talked about where you live. Now let's talk about where you work and shop. Commercial real estate. This is a whole different ballgame. In fact, it's not even one game. It's more like 4 separate games being played on the same field, and they all have different rules.
Wow, okay, this one chart tells you pretty much the whole story right here. Just look at that huge bar for office vacancy rates. It absolutely towers over everything else. While apartments, warehouses, and even retail stores are doing pretty well, the office sector is in a world of hurt. It's a completely different reality.
So yeah, let's start with the elephant in the room: the office. That massive shift to remote and hybrid work isn't just a trend. It's causing some serious long-term pain.
And that pain can be summed up in one jaw-dropping number: 20.7%. That is the national office vacancy rate, a new record high. I want you to really think about that for a second. It means 1 out of every 5 offices in the entire country is sitting empty. Dark. That's the scale of the problem we're talking about.
Okay, now let's flip the script completely and talk about a much happier story. Apartments. This sector has been incredibly strong, super resilient, all because so many people need a place to rent.
How resilient? The vacancy rate for apartments is a tiny 4.1%. And what's really amazing is that this is happening even with a ton of new apartment construction. Developers just keep building more, and renters just keep showing up to fill them. It's pretty remarkable.
Next up, let's talk about warehouses, the whole industrial and logistics space. The absolute frenzy from the e-commerce boom has definitely cooled off, but the sector itself is still fundamentally solid.
The vacancy rate here has ticked up to about 7%. But, that's not a sign of a crisis, not at all.
It's actually a return to a healthy, balanced normal, the average we saw for like 15 years before the pandemic craziness. So this is a market that's normalizing, not collapsing.
And now for what might be the biggest surprise of them all, retail. I mean, just a few years ago, everybody was talking about the retail apocalypse, right? The death of the shopping mall. Well, turns out they were wrong.
And the proof is right here. A retail vacancy rate of just 4.5%. That is near a historic low. After being completely written off, retail is now one of the tightest, best-performing sectors out there. It's this perfect storm of not much new construction and surprisingly strong consumer demand. It's a retail renaissance. Who would have thought?
So we've got this housing market on a plateau and 4 totally different stories playing out in commercial real estate. What's the engine behind all of this? What's the why? Well, it really boils down to a couple of major economic forces that are shaping everything.
For the housing market, you absolutely have to understand this concept called the mortgage rate lock-in effect. Just think about it. There are millions and millions of homeowners out there who are sitting on these incredible 3% mortgages. Why on earth would they sell their home only to take out a new mortgage at nearly 7%? The answer is they won't, not unless they absolutely have to. And that right there is the #1 reason the supply of homes for sale is still so incredibly tight.
And you can trace this all back to a really clear chain reaction, like dominoes falling. Step 1, the Fed raises interest rates to fight inflation. Step 2, that immediately causes mortgage rates to jump. Step 3, with those higher rates, buyers just can't afford what they used to, so their purchasing power plummets. And what's the inevitable final step? Demand cools off, and the market is forced to rebalance from that wild frenzy into the new normal we have today.
Okay, so that's a lot to take in. We've gone from residential to commercial, from interest rates to inventory. So what does this all mean for you? You know, whether you're thinking about buying, selling, renting, or investing. Let's boil it all down into the key takeaways. Let's break down what this new normal actually means for you. If you're a buyer, the good news is the frenzy is over. You've got more choices, a little more time to think. The bad news? Affordability is still a major challenge. If you're a seller, the days of just naming any price and getting it are gone. Pricing your home realistically from the start is now the name of the game. For renters, those insane rent hikes have slowed down, thank goodness, but it's still a pretty competitive market out there. And finally, if you're an investor, you have to remember that tale of 4 markets. Industrial, apartments, and retail all look pretty solid, but office? You need to be really cautious there.
So there you have it. We've moved from a market of extremes to a market that's rebalancing. Prices have hit a ceiling, inventory is slowly healing, and different parts of the real estate world are on completely different journeys. The frenzy is gone. It's been replaced by this complex, tricky, and frankly more challenging new normal. The really big question now is, what does this new normal have in store for us next?